Okay, in this video we're going to talk about some pitfalls in reading the statement of cash flows, and I'm going to break it down into three categories. First, cash flows tend to be more volatile than net income. Second, cash flows understate investing activities. And third, cash flows totally ignore stock-based compensation. First, cash flows tend to be more volatile than accrual-based net income. Net income is designed to be a smooth measure of operating performance that's pretty comprehensive in all the costs and revenues that it includes. Cash flows, though, depend on the timing of when did we receive or pay these cash amounts. Was it before year end or after year end? And this can result in a very volatile measure of operating performance. Smoother is good because it's easier to predict. If I know net income this period, it's a better predictor of net income in future periods, whereas cash flow is not necessarily as good at that task. And let me show you an example. So let's take the example of Tesla. And this was September 30th, 2016. This was the 3 months ended. So this was a quarterly earnings announcement for Tesla. And something that Tesla was particularly proud of was generating positive free cash flow. And I think this was the first time the company generated positive free cash flow. Free cash flow is defined as cash from operating activities, which you can see is positive $423 million in the case of Tesla in this quarter, minus capital expenditures. And you can see that's a cash outflow in that current quarter. So if you take operating cash flow minus capital expenditures, you get positive free cash flow this quarter of $176 million. And Tesla was particularly proud of this. Let's look at their earnings announcement press release. Tesla third quarter 2016 update. GAAP net income of $22 million. And here it is, positive free cash flow. In the first bullet point, they say we had positive free cash flow of $176 million. Okay, good for them. We're very happy for Tesla that they generated positive free cash flow, but you really have to understand, why was it? Was it a temporary fluctuation, or was it a sign that their operating performance has truly done well this quarter? Well, if you look at their balance sheet, you can see one of the main reasons that they generated positive free cash flow was that they stopped paying their bills, okay? So if we look at the current liability section, and this is from the balance sheet, you can see a $628 million increase in their accounts payable and accrued liabilities. Well, when we observe an increase in liabilities, it means that we're not paying off those liabilities, right? And that's a really good way to save cash in our personal lives, right? And for companies. If you stop paying your bills, you can generate higher cash flows. The problem for Tesla and for all of us is that we eventually do have to pay our bills. And so that temporary increase in our cash flow must reverse in the future. So let's look at the earnings conference call that we went through this quarter. And here was an analyst, and an analyst picked up on this, right? Analysts are trained investment professionals, and they'll look at the balance sheet before they just blindly use the cash flow number. Most of the time they'll do that. And the analyst says, "Oh, great, thanks for taking my question. I mean, it looks like a very strong free cash flow quarter, but when I look at the balance sheet, there seems to be a pretty large increase in accounts payable and accrued liabilities. That seems to have helped. How should we think about that going into Q4? Does some of that unwind? Were there any changes to buyer terms of the quarter, or was that just a ramp in production?" Okay, and now here the CFO, Jason, he says, "Sure, yeah, great question. It's Jason." So yeah, there was definitely an increase in payables, and I think that'll start to unwind a bit in Q4. A lot of that's natural. I feel like the production, I believe, it increased 37% quarter over quarter. So there's naturally going to be more parts coming into the factory. So what Jason is saying is, look, we're a growing business, and as we do more and more business, the natural level of our accounts payable balance is just going to increase. Larger company is going to have a larger accounts payable balance. And he says in this next paragraph, the other thing I think is worth pointing out is that the cash flow statement is receivables. We had a lot of deliveries at the end of the quarter. So at the same time, so here's what he's saying. At the same time our accounts payable balance is increasing, our accounts receivable balance is also increasing. So you have to, yes, we had an increase in our accounts payable, but you have to offset that with an increase in accounts receivable. And Elon Musk chimes in here. He says, yeah, definitely. I would like to emphasize that. I mean, it's a first approximation. You expect payables to increase 37% if the company's growing by 37%. And then he says, and then you have to net that out against receivables. When you do that, I think it's not really a material situation, he says. And Jason says no, which is a bit of an ambiguous no, if you ask me. So let's look at receivables, right? Let's verify what they just said. So here we go back to the balance sheet. Here's our $628 million increase in accounts payable. And they said, look, accounts receivable increased at the same time. Well, you calculate that, and that's something like $137 million increase in accounts receivable. And so it doesn't come anywhere close to offsetting the increase in accounts payable. I think there's around a $500 million difference between those two fluctuations. So that's a $500 million boost to free cash flow. Was that the difference in turning negative free cash flow into positive free cash flow? Absolutely. Free cash flow would have been significantly negative if accounts payable only grew at the same rate of accounts receivable. And so what can we predict for this company? What will free cash flow be in the following quarter when they have to settle all of these large accounts payable that they stopped paying? So let's look at the future of this company. Here was their $176 million positive free cash flow for the quarter September 30th, 2016. And you can see the very next quarter, they had negative $1 billion of free cash flow. So that temporary fluctuation more than reversed in the following quarter. So what we can say here is you shouldn't be misled by a temporary fluctuation in cash flow. You have to know the relationship between the balance sheet and the statement of cash flows to use it as a true measure of operating performance, or you could use the income statement as an additional measure of operating performance. The income statement's designed to capture expenses whether or not they've been paid. Okay, the next topic is that the statement of cash flows understates investing activities, especially when the company is using equity to purchase long-lived assets. Also, as we saw, the operating cash flow section of the cash flow statement ignores all capital investment costs because we add back depreciation and amortization expense when we convert net income into operating cash flow. But as for the first bullet point, when we're using equity as payment, let me show you an example of that. So here's Facebook, and in 2014, Facebook bought WhatsApp. What did they pay? Well, they paid $16 billion guaranteed, and that included $4 billion in cash, $12 billion worth of Facebook shares, and there was also an additional payment that they were willing to make of $3 billion in restricted stock units. So that actually brings up the acquisition purchase price to $19 billion. But just for the guaranteed amount is $16 billion, and only $4 billion of that was in cash. So as you can see, only a small portion of this acquisition was a cash payment. And let's look at Facebook's statement of cash flows for this period. So here's for the year ended December 31st, 2014. And this is their cash flows from investing activities section of their statement of cash flows. Here's the acquisition line, acquisition of businesses. And that includes WhatsApp, and it includes some smaller acquisitions as well. And you can see that that's a large negative number. That's negative $4.9 billion. As you can see, this is in millions. And that's a negative $4.9 billion. But that doesn't come anywhere near what they paid for WhatsApp, right? They paid almost $19 billion to acquire WhatsApp. The statement of cash flows only indicates around only around $4.9 billion. Okay, finally, the statement of cash flows totally ignores stock-based compensation expense. So there are many reasons to offer your employees stock-based compensation. Maybe you want to align your employees' incentives with the incentives of equity investors. And to do that, you compensate them with shares so they have the same incentive. The other reason you might compensate your employees with equity is that you don't have any cash. So if you don't have enough cash, you can just give the employees stock instead. So let's look at an example, and again, we'll use Facebook. You can see that Facebook here is converting net income into cash from operating activities. And you can see that net income, I believe this is still in millions, is only $2.9 billion. Cash from operating activities is up to $5.4 billion, so much larger. And one of the main reasons for that is this large number here, $1.7 billion in share-based compensation, which companies always add back. When they convert net income into operating cash flow, you add back share-based compensation. So that is to say, you wouldn't want to compare Facebook to another company that doesn't offer stock-based compensation expense. You wouldn't want to compare those two companies on the basis of their operating cash flow. Facebook is going to naturally have higher operating cash flow than other companies because they're not paying cash to their employees. They're compensating many of their employees with stock. And so that's another pitfall to be aware of when using the statement of cash flows as a measure of a company's operating performance. Okay, in conclusion, we talked about some pitfalls in reading the statement of cash flows. We talked about how the cash flow statement can be more volatile than an income. It should be used in conjunction with other financial information. We also talked about how operating cash flow totally ignores the capital investment. We add back depreciation and amortization. We also talked about how the investing cash flow only includes cash investments and ignores when we use our own stock as consideration in an acquisition. And finally, the cash flow statement totally ignores stock-based compensation expense.